A very good morning. A very good afternoon, everyone. I hope everyone is doing well under the circumstances. Um, and I hope we would be interacting as we normally do today. Today we'll be doing a lot of activities, lots of calculations. We'll be covering mostly the provisional collection method, studying the calculations, covering the theory, and from covering the theory, we will then be tackling the questions. I intend not to cover most questions that are in your study guide, but we may cover one or two. And immediately from there, we will try to apply a few questions. So last week, we covered Learning Unit 3 up until almost halfway, where we covered different types of taxpayers, their tax consequences, their characteristics. So we started with sole trader. We covered partnership, we covered companies, we covered close corporation, we covered small business corporation. So there is a nice summary that I tried to summarize for us to follow. Most importantly, we also learned how to calculate tax liability for a small business corporation. So today we'll just be revising such things. So how we will start immediately, I will share what we covered last time, and then we can continue partaking and working on what we can try to cover today. So previous time we met, we did different kinds of taxpayers. We covered the sole trader, we covered the partnership, we did the companies, we did the small business corporations. We covered most of everything about them. Today we are moving on and we are going to micro businesses. So remember what I said? I said we are working two ways together. Just want to get to page 44. So we're starting today on page 44 of your study guide, which covers micro businesses. So that's where we are starting today, on micro businesses. So you are told that for tax businesses, a micro business is a special type of an enterprise. Very important for you to please note, a micro business can be a company or a sole trader. So it can be a I just want to quickly fix something here on freezing my my things. Freeze first column, right. So the first thing that we are learning is, in terms of the requirements, please forgive my Excel. I will have to make it a bit smaller for you to be able to see everything. So in terms of the requirements, we hear that a micro business can be a company or a sole trader. So it can be companies or sole trader. So we read further, and then the next thing that it touches on is the fact that on how the tax system works. So immediately from there, I would love us to try and cover more detail about a micro businesses on chapter 8. So I would love us to cover more information in terms of chapter 8. Then we can quickly move on. So we'll first start and cover chapter 8 on micro businesses from a textbook, a prescribed textbook. Then immediately from there, we will try to continue with this nice summary that we have per taxpayer. So the first thing is in terms of the micro business, it can be a natural person. So in terms of the requirements, or call it a definition, it can be a natural person. Natural persons, it can be sole trader, it can be companies, and close corporation. So I want you to remember these things. The close corporation. The second important thing about a micro business is that the qualifying turnover must not exceed 1 million. 1 million in a year of assessment. So the qualifying turnover must not exceed 1 million in a year of assessment. So those are the characteristics of what defines a micro business. So we move on and we immediately look at 8.3.1 on the textbook. It tells us what is a qualifying turnover. So what is a qualifying turnover? Qualifying turnover is described or is defined in terms of paragraph 1 of the 6th schedule as total receipts from carrying on business activities, excluding any amount of capital nature, excluding any amount exempt from tax in terms of section 10. So here you are told a qualifying turnover is defined as total receipts from carrying on business activities, excluding any amount that is capital in nature. So one of the things that we are going to have to cover, it is to how do you calculate a qualifying turnover limit to be able to classify a taxpayer as a micro business. So the next thing that we are looking at now is a qualifying turnover. So we are going to try and apply the issue of a 1 million. So I'm going to open a column that we are going to call micro business examples. So this is micro business examples. So we are quickly going to look at the examples that we are going to try to apply quickly. So I am going to try and type very quickly the question at hand. So the question or the example is company X commenced trading on 15 June 2018. Then you are told that total receipts from 15 June 2018 to 28 February 2019 were 775,000. And you are told that this is including 30,000 receipts, disposal, income of some equipment, in the business. So the question becomes, calculate the qualifying turnover. Right, so this is the question. So company X commenced trading on 15 June 2019. Total receipts from 15 June 2019 to 28 February 2020 were 775,000. So that's what the total receipts were. Total receipts is 775,000, and we are told that the disposal in terms of income, it was 30,000. And then you are told that these receipts were made from 15 June 2019 to 28 February 2019. So the question is, calculate your qualifying turnover. So if you want someone who will tell me how do we go about it. So this is 29. And I'm going to single a person. If there is no one who is responding, how are we going to calculate the qualifying turnover? Anyone? So I just need to find someone that I need to mute who's been, so I muted the person. Anyone, Mandisa, Jonchi, what's your take on this? How do you calculate the qualifying turnover? Ndivuo?
Can I help them maybe?
Yes, you can help.
Okay, the qualifying turnover will be that 775, which is on the screen there, plus 50% of that disposal of an asset, since it has been used in the business actually.
So you are saying the qualifying turnover. So qualifying turnover. You're saying, I just want to correctly get you. It's going to be 775.
775,000. Plus 50% of the disposal income.
Anyone else? Anyone else who wants to come in? All right, let us quickly go back and read the definition so that we can get this thing correct. So the definition of a qualifying turnover, it is said that it is total receipts which are from carrying on the business, and then you are informed that it's excluding any amount that is capital in nature, including capital receipts. So this is basically what you are told in terms of the definition. So if you are going to be applying the definition, this simply means to be able to calculate the qualifying turnover, you need to know you have been told that total receipts is 30,000. Now, you've been told, sorry, capital receipts, you've been told that it is 30,000. This one you have already been informed on. Sorry, I just need to quickly change the currency there so that it becomes rands. Right, you have been told that the total receipts is 30 rands, and you are told that the total receipts from 15th June to the 29th of 2020 were 775, including the receipts of 30,000. So which means your total receipts, excluding the other one, is going to become 775,000 minus 30,000. So in other words, we're going to have here 775,000 minus 30,000, which means that your total receipt is going to actually be 745,000. So this is the information that you have been provided. And the question is saying to you, the qualifying turnover is total receipts or excluding any amounts that is capital in nature. So in this case, if you take all your total receipts, which are including the 30,000, you are getting to receipts excluding capital, which is equal to 745,000. So in other words, this 775 was given to you. This was given as total receipts, and you had to exclude what was capital in nature so that you are able to remain with the receipts, which are with the receipts which do not have a capital portion in it. So this becomes then your total receipts excluding any amount that is capital. So your qualifying turnover is therefore 745,000. This is what the qualifying turnover is. So remember, this is as per deflation. So the second thing that we look at, taking the same question, trying to apply example 2. So we're looking at the exact same scenario, but the question now changes a bit. So the company commenced trading on 15 June 2019. And now we're not saying total turnover, we're saying turnover from 15 to 29 February 2020 was 745,000. And then you are asked, the question now is asking you to calculate a turnover limit. So what is a qualifying turnover limit? Remember, by deflation, a qualifying turnover is total receipts from carrying on business activities, excluding any amounts of capital nature, excluding any amount exempt from tax. And we are looking at this from the perspective that the qualifying turnover must not exceed, as defined as a micro business, it must not exceed 1 million. 1 million. So in a year of assessment, so it must not exceed 1 million in a year of assessment. So we already know, in other words, at this point, we can take out this one. So in other words, we already know that a limit of a micro business it is a qualifying turnover of 1 million in a year of assessment. This is what we already know, that a qualifying turnover is 1 million in a year of assessment for a micro business. Now, for this company, where we are dealing with example 2, we are told that the company X commenced trading on the 15th of June 2019. The turnover from 15th of June 2019 to 29 February 2020 was 745,000. Now the question is calculate a qualifying turnover limit. So how do we do this? Remember, a year of assessment in this case would have a year of assessment would have started on the 1st of March 2019 to the 29th of February 2020. This is what a year of assessment is. It is these 12 months in which SARS annually assesses a micro business. Now, when you are calculating a limit, an annual or a qualifying turnover limit in a year of assessment, you have also to take cognizance of the period in which the limit applies. So for this particular company, we are told that they have not been, they've only been trading from the 15th of June. So in your calculations now, you need to be calculating the months in which it will be applicable for them to calculate the qualifying turnover. So in this case, we can already see that they started trading in June. So which means that our calculation of a year of assessment will begin on the 15th of June to the 29th of Feb. So how many months from June to Feb do you have? How many months do we have?
I think we've got 8.
9 months.
All right. There we go. We've got 2 people. Another person is saying 8 months. Another person is saying 9 months. Right. Now, what we are always going to do is we always are going to take an assumption in this case, because they've started to trade in the middle of the month. So which means that the actual period that they've traded is 8 months and half of the month. So basically, this is how you are applying it. So this is, they've actually carried on a business for a period of 8.5 months. Remember, it's calculation from June to December. From July to December will be 6 months, and January and February would be 8 months, and then you have the 15 months of June. So what we are going to do is, even if they started trading on the 12th of June, or on the 11th of June, or on the 3rd of June, or the 27th of June, the fact that on that month they were trading, from a tax perspective, we regard that month as a full month of trading. So in other words, it actually gets us to 9 months because of that deflation from tax perspective. So the 9 months is identified in that way. So which means that now, if we are able to know how much the turnover was, which was as provided in the question, we only traded for our turnover was 745 as given in this example. So when we are calculating a limit, so this means that our limit is going to say 1 million divided or times 9 divided by 12 months. So, which means that in calculating our limit, we're going to say 1 million multiplied by 9 divided by 12 months, which is giving us 750,000. 750,000. Sorry about that. Which gives us 750,000. Now we can be able now to apply to this company and say, do we know if they were within the limit in the 9 months that they were carrying on trade or if they were not? In this particular case now, we can be able to see that the turnover limit, if you were carrying on trade for 9 months, it is 750,000. And in this case, their turnover was 745, which is lower than 750,000. Therefore, they do qualify to be a micro business. So in this case, again, coming back to the definition, micro business qualifying turnover must not exceed 1 million in a year of assessment. So the next thing that we look at in terms of a micro business is it is in terms of the basic framework that you have. Remember, the basic framework was applicable when we were looking at other taxpayers, when we said the method of collection of tax would be they would need to pay, or the collection would be via the provisional collection method, which we are going to be covering today. So if we are looking for a micro business, the question now is, what is the method of collecting tax from them? What is the method of collecting tax from the micro business? So it is simple. Micro businesses, they pay, it is covered on your page 44, where it tells you that a simplified tax system called turnover tax was introduced on 1 March 2009, and it is available to all entities that qualify as a micro business. So it's called a turnover tax. That is the system, and the system provides for a single tax called turnover tax, which is a substitute for income tax, capital gains, value-added tax, and dividend tax. And you are informed that the system was mainly introduced to reduce the tax compliance burden. The micro business pays tax on its taxable turnover on micro business rates, which is a very low rate. So in terms of the tax rate that they must pay, we know that there is a micro business tax rate, which we have to look at in terms of the table. So I'm going to be providing examples which we are going to apply. So, and of course, one of the other important thing is in terms of the collection, how you are paying the tax liability to SARS. There is there is interim payments that you make, and this we're going to cover on page 46, where the first interim payment is made within the first 6 months of the year of assessment. You've got a nice illustration on page 46 of your study guide, which shows you how the interim payments are made. So in terms of the method of tax, we've got interim payments, which we must look at. And the year of assessment, that's one of the things that we are going to be covering as well. So we have covered a qualifying turnover on page 45. They provide you a similar example of doing a qualifying turnover. So what I want us to quickly do, it is a question on page 46 on blue solos. And this is going to help us now to apply a basic framework to calculate tax liability, which is called now interim payments for a micro business. So we've got Blue Swallows CC. So let us quickly look at the question. So Blue Swallow CC is a registered micro business. So in this case, you are informed you do not need to apply the definition. On 31st August 2019, it was estimated that the taxable turnover for the year will be 500,000. On the 29th of February 2020, the estimated taxable amount, turnover amounted to 620,000. And you are asked to calculate the first and the second interim payments to be made by Blue Swallow CC. So we are asked to do a first interim payment and as well as a second interim payment. So this is what we are given. We are given an estimated taxable turnover. I'm just going to show here that we are dealing with rents. And in this case, we are told that it's 500,000. And the first thing that we must do, it is to calculate a tax liability. And the question now becomes, where do you get this information about the tax liability? So this information you get if you look into your textbooks. You will be able to see the information about the tax rates that are applicable to a micro business. You've got a nice appendix that gives you rates applicable for each of the relevant taxpayers. So I've got mine, I've found it, it's Appendix A. And I quickly want those who have got textbooks to quickly look for it. What I'm going to be doing for those that do not have it, I am going to also be sharing it. What do we have for this year? So for those who have got this table, they can proceed to do the calculations. I am just quickly going to share to those that do not have the textbooks that I quickly share to them this nice table. I'm thinking the best way, let me quickly this thing on SARS. Right, copy it. All right, so those are the rates that we have that you can also find in terms of looking at it from the Appendix A from behind of your textbook. So the first thing that we have to do now, which is to calculate how much tax can we get from the taxable turnover. So how you look at this, anyone who can tell me how you do it?
Can I try the first one, please?
Yes.
I think the first one we're gonna say 500,000. Then we go to the tax rate, which is, it says 335,000. We minus that from the 500,000, and then we take the answer, we multiplied it by 1%.
All right. Thank you very much. You got it right. So in essence,
Thank you.
one of the things that makes micro businesses to have a good benefit, it is the tax benefit, because the first 335,000 that you make is not taxable. So that's what we have to first take out. It is the first one that is not taxable. So the non-taxable one, because of the benefit. So the non-taxable one, because of the benefit, would be 500,000 minus 335,000, which is sorry, what is not taxable is the 335,000. So what is taxable then means it is 500,000 minus 335,000. This is what remains and becomes taxable. So this is your taxable turnover. This becomes your taxable turnover. How much is taxable? So if we were applying an income tax, we would say this is your taxable income. But because it is a micro business, the language that we use, we say taxable turnover. So the tax that will be now applicable, it will be at 1%. So this would be at 1%, which is going to be 165,000 times by 1%, which gives you 1,650. Now, the first interim payment, in terms of the formula, it says it is tax payable for the year, and you divide it by 2. Why you divide it by 2? It is because you are paying this as an interim payment during the year. So you are paying 2 payments for the whole year, but because SARS needs to ensure every taxpayer is able to pay and able to provide funds during the year to SARS to be able to run and to be able to provide as well to the nation to run from a government perspective. Now, SARS needs to collect biannually on the first 6 months of the year, the first interim payment. So if we are looking at this example, let me look at the dates. On the 31st of August, the first interim payment would be due on the 31st of August, 2019. This is when the first payment would be due on the 31st of August, 2019. Now, when the year ends, you have been informed in the question that for the second part of the year, you have an estimated taxable turnover of 620,000. Anyone who can quickly do the second calculation? 620,000, what do we do on this one?
Can I try again? We say 620,000 minus 500,000, which is non-taxable, and then we multiply the answer with 2%.
All right. So what we're basically doing here is we applying a range where 620 falls in. So in terms of the tables, 620 falls in on 501, 500,001 rand to 750,000. So what we're going to do in this case is, we are told here that the tax is 1,650 plus 2% of taxable turnover above 500,000. So one thing that we know already is we have the 1,650. Now what we need to calculate is what is above 500,000. So what is above 500,000? It is 120,000. So we need to calculate tax at 2% on this on 120,000, which is 120,000 multiplied by 2% gives you 2,400 plus the tax liability that you are already given, which is 1,050. Which is 1,050. So which means that your tax liability then becomes 2,400 plus 1,650, which gives you 4,050. This is what becomes your tax liability for the year. I want everyone to remember this is for the year. And what do we want to do here? We are calculating a second payment. We are calculating a second interim payment. So the first thing that we have to do now, we have to say less what has been paid in the year, which is less the first interim payment, which we have already paid for on the 31st of August 2019. And this is going to give you this is going to give you 4,050,000 minus 825. So which means that on the 29th of February 2020, this is the amount that is due by the by Blue Swallow CC to be able to pay to us as SARS. So this is 3,220. So this is how you calculate the first interim payment. This is how you calculate the second interim payment. This is how you calculate the qualifying turnover limit. This is how you calculate the qualifying turnover. So before we proceed and move on, there are a couple of other things that I would love us to quickly look at in terms of chapter 8 on your textbook. On who qualifies to be who qualifies as a person to be a micro business and who does not qualify. So we're going back to this. On 8.3.7, you are told that persons that do not qualify as a micro business are natural persons that have shares in other companies. So those are the people that do not qualify. It is people that have got shares in other companies. No, I'm not going to put a summary on this. I'm just going to read it out. 2, it is natural persons who whose total receipts is more than 20% of income that they are rendering from the professional services. So it's 20% more than the total receipts. If a person is a personal service provider, a labor broker, if the total of the following amounts exceeds 1.5 million over a period of 3 years, receipts of disposal or sale of immovable property, receipts from disposal of any capital used or mainly for business purposes. And for companies or close corporation, the ones that do not qualify, that cannot register as a micro business, is if the last day of assessment, the year of assessment must be 1 March to 28 or 29 February. Anything in between does not become a taxpayer. So companies who qualify or those corporations who qualify as a micro business, their year of assessment must be 1st of March to the 28th or the 29th of February. I'm trying to think now what else we need to cover in terms of the micro business. I think one of the things that are important that we need to cover is the taxable turnover. So in this case, we have been given what a taxable turnover is. So I just want for you to know how to calculate a taxable turnover using the basic framework as you have done with taxable income. So one of the important things is that it is revenue, it is receipts or revenue, then it is 50% of capital receipts received in a year, and this makes for you total turnover, total taxable turnover, and then from here you can be able to calculate tax using micro business rates, and then you can be able to calculate first interim, first and second interim payments. Right.
Hi, so sorry to disturb. Just a quick question regarding the 50% of capital receipts. Do we always deduct that from the receipts or revenue amount?
No. Remember, when you are given the question, you'll be given how much of the capital receipts were made. So you'll be told that on disposal of an asset, this is how much was made. If it was 60,000, you have to only take 30,000 of that amount if you are calculating a taxable turnover.
Okay. But do we always deduct it, or would there be instances where we have to add it or not?
The other 50%, remember, you are adding. So this is add. This is plus.
All right. So
this is plus. So for example, if we had revenue of say 650,000, and that you are given in a question that capital receipts were 30,000, this simple means that you are going to only add 50%. You are only going to add 50% of the capital receipts. That's all that you are going to do. So you're not acting, you are only adding.
Okay, perfect. Thank you so much.
So your taxable turnover then becomes this amount. So quickly, as a quick exercise, can someone tell me how much tax we have to calculate on 665,000? How much tax on 665,000?
We say 665,000 minus 500,000. Then we multiply the answer by 2%.
Is that all?
Then to calculate the first interim, we will
No,
divide.
no.
Okay.
No. Remember, you say.
Oh, plus the 1,650.
Yes, 100%.
Yeah.
So if anyone can quickly see if this is the amount that they got, 4,950. Any person who is not getting that may quickly tell me that I am not getting that.
It's correct.
Right, lovely. So that is the summary on micro businesses. The important thing, it is to know how to apply the tax tables. It is important to know the definition of a turnover, a qualifying turnover. It is important to understand how to calculate a qualifying turnover limit and apply it to the receipts that were received in the current year. The basic framework, how to calculate the interim payment and the second interim payments, they are always based on estimated taxable turnover, which you will always be given. But in some of other instances, you may be given a qualifying turnover and you may be given capital receipts as well. And all you need to do is to calculate how to get to a taxable turnover. So we are now on page 47 of your study guides, which covers trust. The most important thing that I want you to know about trust is that they are established as a vehicle for tax and estate planning purposes. The tax rate that is applicable for a trust is 45%. That is the main important thing that you must know in this learning unit is, we've got trust. The only thing that is really needed for you to know is that the tax rate is 25%, which is a flat rate, and the method at which to collect taxes, it is the provisional tax collection method. So those are the important two things on trust that I really want you to know. Then you've got farmers, and you are told that farmers are just mentioned so that you know that there is other taxpayers called farmers and also other taxpayers which have been classified on the below page of page 48 as retirement funds, venture capital companies, and all those. Now we are going to look at 3.9, which is almost where we've been working towards, which is the provisional tax collection method, where each entity is paying provisional tax methods, and then we are going to learn how do they do that. So you are given a background on 2.9 that if you are employed and you are earning a salary in a company, monthly there's a deduction of pay as you earn, which is a deduction which is paid over to SARS as a method of collecting monthly tax from you, so that at the end of the year, SARS does not sit with a debtor or someone who will not be having cash to pay the tax. So it's meant to also help the taxpayers whose financial situation may differ at year end. So as we have covered all the taxpayers, you have identified that we have said most of them, the method at which they are going to be paying tax is by provisional tax payments. And that's what we're going to cover as to how is that done. So on 3.9.1, you are given that for the first provisional tax payment, there is a process that you need to follow. So if you're looking on page 51 and page 52, you are given 3 provisional tax payments that you have to make. first provisional payment, second provisional payment, and third provisional payment. So the first thing that we have to cover now is in terms of the first provisional payment, what are the steps that you need to follow in calculating the first provisional tax payment? You are given 3 steps. That 1, you need to determine a basic amount. 2, you need to calculate the normal tax. 3, you need to divide that by 2. So we're looking at page 50 at the top. Page 50 at the top gives you a summary of what we will be covering in terms of page 49. So if I may start now, I'll start on page 49. For us to calculate the first provisional tax payment, we need to first know what is the basic amount. So on page 49, the basic amount is defined 1 as taxable income assessed by the commissioner for the latest preceding year of assessment, less taxable capital gain. And you are told that the latest preceding year of assessment is deemed to be an assessment relating to the preceding year of assessment where a notice was issued more than 14 days before the date at which the current provisional payment should be submitted to the commissioner. And then you've got number 3, which tells you that the basic amount must be increased by 8% per annum if the date when the basic amount must be calculated is more than 18 months after the preceding assessment. So let us now try and apply this from the example provided in the question. So we've got an example provided where we are going to apply this theory of Foodie Pty Ltd. So page 50, I can also go to page 50 here, start to read it from here. Page 50 here, you are told that Foodie has a 31 March 2020 year end. So remember the requirement here, it is to calculate first provisional payment. So if Foodie Ltd has a 31st March 2020 year end, the question is, when is the first provisional payment due? Anyone?
In July.
So the first provisional payment is always due within first 6 months of the year of assessment. I'm trying to give you step-by-step breakdown. So the first provisional payment is due within the first 6 months of the year of assessment. Now, if Foodie's year of assessment is 31 March 2020, when is the year of assessment starting? It started, so it means that the start of the year of assessment would be 1st of April 2019. And the end of year of assessment, start of end of year, you are told that this is 31 March 2020. Right, let me leave that as it is for now. So this is what you know. So the first provisional payment is therefore due on the last day of the 6 months. So it's due within the first 6 months, which means that on the last day of the 6 months. So in this case, it is due. Let's calculate what is 6 months from 1st of April.
On the 30th of September.
Is it 30th September? Does everyone agree?
Yes, agreed.
Give me the year. 30th of September
2019.
So this is when the first provisional payment is due, 30 September 2019. So let us now read further information. So, oh, sorry, I did not even see that they have already provided this to us in this example. Please note, this will never be provided in an exam. The accountant, Mr. Fast Fingers, realizes that he needs the basic amount to calculate the first payment. The 2019 taxable income has not been assessed yet. So remember, this is a 2020 year that we are in, and you are told that the previous year, which is 2019, has not been assessed yet. So remember, by definition, basic amount on the on page, you are told that the basic amount is deemed to be the taxable income assessed by the commissioner for the latest preceding year of assessment, which means from the previous year of assessment less taxable capital gain. So in this case, in this question, you are already told that that information is not available for 2019. Then for 2018, we are told that the 2018 year of assessment was assessed on 20 September 2019, and the taxable income was 400,000. So this is for 2018 year of assessment, 400,000, and we are told that it was assessed on 20th September 2019. So remember, the 2019 is the year that we are on. So now what we have to do now in this particular case, it is now to look at to whether this taxable income, I'm now looking at page 49. We have to look at whether the notice was issued more than 14 days before the date at which the current payment is due by SARS. So, which means that we are looking for the 14-day rule. The 14-day rule looks at the date in which the assessment was due. So the assessment is due on 30 September 2019, and you are told that this is the 2018 taxable income that we are selecting was assessed on 20th September 2019. So what we are looking at is whether it was assessed more than 14 days from the date that the amount of the tax provisional tax payment is due. So in this case, what is the answer?
It's less than 14 days.
So in this case, you can see that from the 20th of September to the 30th of September, you've got how many days? 10 days. And you are told for you to apply the income of 2018, it must have been assessed more than 14 days from the date on which the notice was issued by the commissioner. So in this case, it's 10 days. Now, because it's 10 days, it means that we cannot select 2018. We need to move on. So what else is provided on the information? You are told the 2017 assessment 2017 year of assessment. The assessment was done on the 30th of April 2017, and the amount was 320,000. I just need to fix the currency. So you are told that the 2017 year of assessment was assessed on the 30th of April 2017. Now one can already see that between the 30th of September and the 30th of April 2017, it's more than 14 days. So which means we can now be able to take 320 as the basic amount. So we are able now to take 320,000 as the basic amount. Now, the next thing that we are looking at now is we are told that the basic amount must be increased by 8% per annum if the date when the basic amount must be calculated is more than 18 months after the preceding assessment. This means then we have now to apply 18 months rule. So 18 months rule assesses how old is the taxable income that you have selected. So how do we measure this period? Now, to measure this period, we have to look the year of assessment of 2017. When was the last day for the year of assessment? So in terms of the year of assessment, the last day was 31 March 2017. And we compare this date to the date on which the first provisional tax payment is due. So we compare this to the date for first provisional payment, which is the 30th of September. Now I need you to calculate how many months do we have between 31 March 2017 and 30th September 2019. Could you quickly calculate for me how many months we have?
$30 months.
30 months. So we've got 30 months here. Now I want you to reflect back. Sorry, 14 days rule. I want you to reflect back. Now, the Income Tax Act says because you have went back so much for up until you were able to select a basic amount in the 2017 year of assessment of 320,000. You must now adjust that amount per annum. So which means that you need to adjust the amount for the 2018 year, the 2019 year, and the 2020 year that you are on. Remember, the amount is correct as per 2017. You need to adjust it now for 2017, sorry, for 2018, for 2019, and for 2020. So how do you adjust it? You adjust it by applying the 8% per annum. So which means in this case, we are going to say 320,000. 320,000 multiplied by 8%, multiplied by 3 years, which gives you 76,800. So you're going to have a basic amount which is equal to 320,000 plus 76,800, which gives you 396,800. That is the basic amount that we are looking for. Now, in this case, remember we are dealing with a company. A company's tax rate is 28%. Now, for us to calculate the first payment, we first need to calculate a tax liability. A tax liability is going to be calculated at 28%, which is going to be 396,800 multiplied by 28%, which is going to be giving you 111,104. Now, because you are only doing the first payment within the first 6 months, this means that you need to divide the amount that you have by 2, because this amount relates to the first 6 months. So, which means that you are going to say 111 divided by 2, which gives you a tax payment of 55,502, and this becomes your first provisional tax payment. So that is basically how you calculate the first one. And then the second one is provided in the example. It's provided in the study guide on page 52. It says for a taxpayer with a taxable income of 1 million or less, start with the lower amount of basic amount or the estimated taxable income. For a taxpayer with a taxable income of more than 1 million, start with an estimated taxable income that was seriously calculated. And then you are given a formula in which you are going to do a calculation on that. So what I want us to do, I want us to do a calculation on 3.6. Wait, not 3.6. Right. I just want, for illustration purposes, for us to look at question 3.2. One of the good things from lecturer's perspective that I want you to note in this syllabus, calculation on provisional tax payment will only be for companies where the tax rate is at 28%. So you will not need to calculate for a small business corporation or micro business. It will only be for a company where a tax rate liability is 28%. So let us quickly look at 3.2. So question 3.2, it is on page 55. The question is about LoveBed. LoveBed is one of your clients. The financial year of assessment ends on the last day of March. LoveBed is not considered a small business corporation as defined or a micro business. You are provided the most recent tax assessment have been as follows. And then you are asked to calculate the provisional tax payment payable by LoveBed for the 2020 year of assessment. So remember the first step, when is the provisional tax payment due? It will be due now if the year end of this company, it has not been provided. So let us assume it's still 31st March. So it will be the 30th of September 2020. 2019. So in this case, if you are trying to calculate a basic amount, the basic amount by definition is the taxable income that was assessed in the previous year of assessment. In this case, which one would be applicable? Anyone? Question 3.2, page 55 of the study guide.
$160,000.
Why not 1 September 2019?
I'm not sure. Oh, we are on 2020. Yeah, I think you're right.
So remember, the first assessment would have been assessed. It's not within the 14 days. So it was assessed on the 1st of September. I said an assumption that we have to make here is that love bets financial year ends on the 31st of March 2020. So in this case, to calculate the first thing, the first provisional payment, the basic amount that we would have to look at is in the previous year of assessment, which we have been provided, when was it assessed? So we can see that the notice of assessment was on the 1st of September. So which means that we can be able to take this basic amount of how much? 200,000. And then we can be able to calculate the tax liability. It's going to be 200,000 multiplied by 28%, which is 50,000. And then you're going to say for the first provisional payment, you must divide 56,000 by 2 to get 28%. Now I want us looking at the same information. I want us to look now at calculating the second provisional payment. Now for us to calculate the second provisional payment, remember, in terms of the principles, we know the following. If the amount is exceeding 1 million, we have to use lower of the basic amount or the estimated taxable income. So in this case, let us quickly look. The 2020 financial statements were finalized during July 2020. On 31st July 2020, the accountant calculated the company would have a taxable income of 300,000 for the 2020 year of assessment. So this simple means on the 31st of July 2020, the accountant provided you a taxable income. So in this case, the question then becomes the second provisional payment, when would it have been due? Remember, this one would have been due on the 31st of March 2020, on the next 6 months. This one would have been due on the 30th of September 2020. So I want you to look at this date. So on the 31st of March, we wouldn't have had an estimated taxable income. So in this case, what we have to do now, it is to look at the lower of the two, one being the basic income or the estimated taxable income. Now, in this case, we do not have the taxable income. It's not given. We don't have it. It's not given. But the basic amount, we know of because we have already calculated the basic amount in the preceding year of assessment, which is 200,000, and we have already applied it for calculating the first provisional payment. So tax at 28%. Tax at 28% is going to be 200,000 times by 28%, 56,000, less first provisional payment. I want you to now remember this. Less first provisional payment. So this means that for your provisional payment, second provisional payment, you're going to have to pay how much? 28,000. Now for the third provisional payment, in this case that we have to do a calculation for. Remember, when would this third provisional payment been due? It would have been due on the next 6 months again, which is now 30th September 2020. This is now 6 months after year end. The third provisional payment would be due. Now, let us go look at what is the formula that we have to look at now for calculating the third provisional payment. Now, the third provisional payment, we have to determine an actual taxable income, and then we have to calculate the tax liability. So it's actual taxable income. So in this case, we have been provided it where we were told that an accountant has calculated an actual taxable income of how much? 300,000. And then we have immediately calculated tax liability at 28%. So it's 300,000 multiplied by 28%, which gives you 84,000. So you have to say less first provisional payment and less second provisional payment. The first one was 28,000. The second one was also 28,000, fortunately. Let me just quickly go take this one where it was. So the provisional payment, sorry, the payment now that we have to do now, therefore becomes how much? 28,000. So this means that every 3 months, sorry, every 6 months, you have had to do what? To calculate a provisional payment due. The first one, we apply the 14-day rule and the 18-month rule. The second one, you apply, if the amount is less than 1 million, you either take lower of basic amount or estimated taxable income. And if it's more than 1 million, then the rules change a bit, because that's what we have to always be flexible on. Because if it's above 1 million, then you have to take the estimated taxable income that was calculated seriously. And therefore, this is how you apply this. So with all this being said, what I need you guys to do for me, it is to calculate on this question. I need you guys to calculate the first provisional payment and the second provisional payment. Can anyone see this question? Can we all see this question?
Yes, we can.
Yes, can.
All right. In the meantime that you're going to be looking at the question, I just want to quickly see. Please make sure that you are completing feedback before you leave. Make sure let's also make sure that we also let's make sure that we also complete the attendance register. So it's the attendance register and the feedback form, which are available when you are clicking on chat. So as you are attempting this example, question 1 is an objectivity test. I need you to calculate the first provisional payment and the second provisional payment. And I just want to give over to Mrs. Wenzel, maybe to just, who is a lecturer who is with us today. Maybe she may want to just give one or two, anything that she may be able to provide to you as students, including the any exam technique, including on this learning unit or any other learning unit that she may wish to highlight. But Mrs. Wenzel, I'm not sure if you knew that I was going to give you a floor, but while students are attempting this question 1, which is the objectivity test, do you mind just greeting us and sharing any useful insights for students that you may share on your side?
Hi, Zukisani. Yeah, Lenata here. Thank you for including me in the discussion. I am just sitting on the side and I'm not critiquing. I'm not here to judge. I am very glad for everything that you are doing for our students. You are doing very well. Thank you for that. I've listened through the whole section today, and I think you've highlighted all the important things. It's very important for students now to go back and do examples themselves, do it over and over and over again so that they get comfortable with how to approach a question like this. You've highlighted, if we talk about the provisional tax, first to determine what is the date that the provisional tax payment has to be made, because that date influences the amount of the basic amount, which assessment you're going to use for your basic amount. And then the second one, if you now have that amount or that date of the last assessment, then you must go and determine whether the 14-day rule applies, whether you can use that last assessment. And if it's within the 14 days before the date of payment, then you have to use the year of assessment before that. Now, if you've determined that amount, then you have to see whether that assessment that you are using is older than 18 months, in which case you have to adjust the amount with the 8% for 2 or 3 or 4 years. So that's basically the way of thinking of answering a question like this. I see the time is already up now for your presentation, so I'm not going to take you through the whole question. We can maybe do that on another stage if the students request that. But I also have to say that this question specifically, which is part of tutorial letter 201, there is a video on how I present or how I would show the exam technique of answering this question in the discussion forum on MyUnisa. So if you go to the main MyUnisa page, not the eTutor page, the MyUnisa page, under the discussion forum, Learning Unit 3, one of the discussion lines is the provisional tax video. And there's a link to the YouTube video where I actually present this. This was now recorded in 2018, but all the rules still applies in this case because there's no legislation changes for the provisional tax. And since this is a future year of assessments that we've used, you can assume that the current year of assessment is 2050. So that would be your year of assessment that you are working with. Yeah, that's all from my side. Provisional tax is quite a difficult topic to get under the belt, but the only way is by exercising and exercising. Please go through the study guide together with your textbook. We try to explain it as we would in a class in the study guide, but the textbook also gives you a lot of information, and then go through all the questions at the end of the study guide together with this one that is currently on the screen, which is included in tutorial letter 201. Are there any questions directly from the students for me? You are welcome.
Thank you very much, Ms. Wenzel. And of course, the students, there you have an opportunity to ask any questions that you have. Please use this window.
Hi. With regards to the exam, how is the exam going to be set out? Is it going to be a multiple choice or, yeah?
Okay. The exam will definitely be an online exam. It seems that venue-based is something of the past. It seems that UNISA is not going back to venue-based. So firstly, it will be an online exam. Then it will be a written out exam, not multiple choice. It will be similar to all the old exam papers where you have 4 questions. You will download the paper like in the May exam session. If you have written that, you will download the paper, write it out or type it out, scan it in and submit it on My UNISA. There will be extra time for that, for the online portion of downloading and uploading. But it will be like the questions that is in your study guide and in Tutor Letter 201, which is a simulated exam paper, which is written out, calculated questions, and also a theory section where you will also have to apply the principles in writing in a paragraph. So no multiple choice, because you are not, we are not training you in answering a multiple choice type of questions. Those are actually more difficult than answering a normal question. And the time is also very I would say precious when you have a multiple choice, because there's a lot of reading going into it. If you think that we would ask a provisional tax question, for every question we have to give the detail of that company, and it give assumed amounts so that you can go on with your calculation. So multiple choice is not preferable in this subject. Does that answer your question?
Yes, thank you so much. Thank you.
Okay, thanks. Anyone else?
Hello, ma'am.
Yes. What can I help with?
Yes, I only joined now, so I would like to know if there were recordings and where can I get these recordings?
All right. I will respond to that one, ma'am.
Thanks.
Yeah, the recordings, if you can follow on charts, the recording will be provided, but as well, if you get under My UNISA, you go to the Western Cape region and you click on tutorial classes, and then you go under TAX2601. You will see notes that I would have uploaded per each session, and you will also see the recordings that have been uploaded per the previous 2 classes that we have had. Thank you. Anyone else?
Can I quickly add, Sukisani?
Yes,
I want to caution the students not to only rely on the presentations and the online classes and the recordings. This is an additional tool, so don't only do this in terms of getting your knowledge to pass this exam. You have to work through your study guide and the textbook to get the knowledge. And then this is an additional tool to explain and to get you familiar with the situations. Sorry, I'm coming back to provisional tax now. What I would suggest, for instance, is now to go to that question which were on the screen, which is in Tutor Letter 201, the provisional tax question, and go and do it yourself. And try very hard to get the principles that you need to apply. Then you go to the video and you go and see where you went wrong. This is the best way to learn, is to first do it yourself. And then when you see a recording or an online presentation, then you can see where you went wrong and it will explain what you should be doing. So also in future with this forum where Zukisani is presenting, I would suggest to go and do your homework beforehand. Go through the study unit that he is going to present and already know what he will present and what is the principles, and then his presentation will basically ground your knowledge, and then you can also be there with a question which you don't understand. So please don't rely on the recordings. Go through your study material first and use this as an added benefit.
Thank you very much. We've got a hand from Tandeka. Is it Tandeka?
Yes.
Yes.
Sorry, sir. I was also checking where do you type Western Cape to search for the recordings? And I like what Em just said, to go through the study material and then use this as a platform to gain more understanding as well.
All right. Bronwyn will be sharing the link as well on the chat. Please follow the link that will be posted, where you will find the material. Myself as well, I can share the link for you, where you can find the modules that the Western Cape is providing for the semester. So you can just take that link, click it, and you'll be able to see not only TAX2601, also other modules, the recording, including the notes that have been shared, where the relevant tutors have shared the relevant material.
Thank you very much, sir.
All right, I take it that we don't have any more questions?
Hi, sorry, I just wanted to know, is it possible to get like a distinction for this module? And what would be like the best way to like work towards a distinction for this module?
We have a lot of students that have distinctions. It's definitely possible. We even have students with marks in the 90s. The major point where you get a distinction or a good mark is with your exam paper, because that counts 80% of your final mark. So you have to be prepared for the exam paper. But the year mark is also very important. So working throughout the semester and doing the assignments diligently and with effort will give you a good year mark, which is a good base, and which might just push you over either the pass line or the distinction line. And so passing this module and doing well in this module takes time. It's difficult. It's a lot of detail. It's a lot of things to exercise and to do practically. So work throughout the semester. Get the theory in your mind, and then exercise with questions and questions and questions. So there's a lot of questions, like I said, at the end of the study unit and tutor letter 201. There's also old exam papers, although we do not provide the solutions to them because of the legislation changes, and it might confuse you. But if you want more exercise to get a distinction, you can attempt those exam papers and then send them to the TAX2601 email module, and we can give you a guidance on where you still need to apply your mind where you're on the wrong page. Yeah, I think that answers the question. It's basically time and effort and exercise. First the theory, and then doing questions, also under a time limit with like exam pressure, because you might feel you're capable of doing the question, but when you're pushed for time, you're stressed, and the situation is difficult, then you might battle to get the right answer on paper. So exercising under exam conditions beforehand would probably be the best way that I can explain it.
Thank you. Thank you so much.
Thank you. Let's see, anyone who still has a question? Yes.
Thank you so much to both of you. I had a question, but I didn't want to disturb you, Mr. Mbisi. The turnover language is only applied to micro business.
That's correct.
And then the one thing I'm still struggling with, as she was also saying, is on the provisional tax. When it comes to the dates you are given, you always calculate the 12 months of that business, and then you consider with the year SARS of assessment. I don't know if you get that one.
Yes, that's basically right. It's a little bit more complicated because you basically have to take a question to explain it very well. I always use a timeline. I always dot on a horizontal line which year am I busy with, which dates and amounts do I have, where do they plot in, and then I can easily see do I already have this assessment by the time that the provisional payment has to be made, and does the 14-day rule apply? Is it now 18 months before or later? So a timeline helps a lot. You'll see in that video recording on my UNISA how I explain it on the timeline. That's basically the best, because the dates will confuse you if you don't really have a good foundation of what happened when. That will help you a bit.
Thank you so much, because I really struggled with that even when I was finishing my assignment, when I could see I can't put those dates together. Thank you so much. I will try my best.
Okay, thank you.
Now we also go through with the examples that we did today on class, and specifically look at how we broke down what is the first step that you do, what is the first thing that you have to know, the start of the year of assessment, the end. So those are the important things. When is the first payment due? And then you apply your principle now based on that information that you have. But I think Ms. Wenzel has summed it well. Also, go read again, study again the theory part, and then go and apply all the additional resources now available as part of your practice.
Thank you so much.
Thank you. Do we still have more questions? No, it doesn't seem like we have more questions.
Mr. Nkwisi?
Yes.
The last question.
Yes,
I paid my registration end of June. Up to this time, I never received any study material. I wanted to ask her, are we not receiving a hard copy of study material? Are we relying on the one we got on my UNISA?
Yes, I can answer that. Yeah, due to the restrictions and the COVID-19, the study material is going out later than expected. Apparently, we've had confirmation that it was with dispatch a week ago, so it would have been already posted as we speak now. So it's probably on its way to you. But the way that UNISA is going, and I think the world, not only UNISA, many other universities as well, is online. This subject will be fully online, only online in 2022. So UNISA will not be printing anymore by that time. But for this year still, we are giving you study guides. It's printed, it's at dispatch, it will reach you. But in the meanwhile, you will unfortunately have to use the online and use this time to get used to the online process, because that's the way that the world is now going. Sorry about any delay in the study material. Unfortunately, the lecturers has no control over it. Due to the little people that were allowed on campus, things couldn't happen as it was planned, and that's why the study material is late.
All right. Thank you for that. It looks like that was the last question. Please ensure that for today's class, you complete the feedback form and attendance. If you scroll down, you can be able to find there's answers that have been provided as well as to where you can find the notes and the recordings. These have been shared by our UNISA colleagues who are providing a good support for these classes. Please, very important, please make sure you complete the feedback form. And there's also ctntat@unisa.ac.za for any administrative queries that you may also have. Ms. Wenzel, I guess, thank you very much for also providing the insight on your side. I just want to quickly check now with everyone. The question that I posted, question 1, is available on the notes on today's session. I just want to get quickly, was everyone able to do the first provisional payment and the second?
I only did the first one.
Right, let's hear the answers for the first one.
I worked it out to be 456,150.10.
Okay, take me through the steps that you followed.
Okay, so basically I said when would be my first provisional date, and I put it as 30 September 2049. And then I went back to look at which date. So the first assessment so that I can find my basic amount, I looked at 25 November 2049 and that amount, and it seemed as though it didn't meet. It was already after 30 September 2049, so I didn't use that one. I used the assessment of the 19th of August 2049, which was the amount, basic amount of, how much is it?
Yeah,
3,200,000. Yes, that one. And then it's worked out to be more than 14 days. So it met the 14-day rule. But because the assessment date, which is the part I wasn't sure what to do, the assessment date, even though it's for the year of 2048, the assessment date is 2049. So it doesn't meet, I don't know here if I made something wrong, it doesn't meet the 18 months rule. So I then only went on to use that 3 million, and I found the 28% of it, and then I divided it by 2. That's how I got to that amount.
Let me stop you right there. So the
Yeah.
first thing that we did is to look at the year of assessment. So the year of assessment would be 1 March 2049.
Yes.
Because you have been told here that the year of assessment ends on 28 February 2050, which means that the year of assessment starts on the 1st of March 2049 up until the 28th of February 2050. So the first provisional payment due date would be?
As I said, it was 30 September 2049.
Just calculate for me, that is the 6 months from the 1st of March.
Is in August and August. I'm trying because I get confused.
100%. So the first provisional payment is actually 31st of August 2049.
Oh, okay, that's where I went wrong.
So that's why it is important that the first step, it is to determine the year of assessment. The second one, when would the payment been due? Then this date helps you to be able to assess when you are looking at the taxable incomes of the previous year that were assessed. On which date were they assessed? Was it more than 14 days from this date of the 31st of August? So if we're looking at 2049, you will see that it's after the 31st of August 2049. So on this date, it means we never saw this income.
Yeah, okay.
So then we look at the next one, 2048. We see that it was assessed on the 19th of August. So which means that now we must calculate between the 19th of August and the 31st of August, how many days do you have?
It's less.
How many days?
It's I think it's 12.
So you have got about 12 days. So which means that now you're going to say the 2048 year of assessment is not more than 14 days. Therefore, you cannot take it. Therefore, you are going to relook now at 2049 2047.
Seven.
On
Mm-hmm.
2047, you look between the 7th of July 2047 and the 31st of August 2049, and you can pick up already that that is more than 14 days.
14 days, yeah.
So which means that the basic amount that we are going to select is that amount that is in 2047.
Mm.
The second rule that now we look at is from the between the year of assessment of 2047, which is now the 28th of February 2047, and to the 31st of August 2049. Is this period more than 18 months? That's the second
Yes,
thing that
it's
we
more.
look at. So how many years do we have? We've got 2 years and 6 months, which means we've got 30 months. So if this is over 18 months, it means we have to adjust every year from the 2047 assessment, which means that we have to adjust each year by how much? 8%. So we have to adjust which years? 20, 48, 20, 49, and 2050, which makes that 3 years that we have to adjust on, which means that now we have to say 2,999,775 multiplied by plus 2,999,775 multiplied by 8% multiplied by 3 years. It is then going to give you the taxable income that you need now to calculate your tax on. Can you guys see how tricky this is?
Yes.
That's why you need to get the foundation correct on this. So I'm going to, this question is shared. I hope I've got this thing right as well. Which you're going to say now times 28%. Gives you 1,041,521. 22 divided by 2 then gives you 520. 761 becomes your first provisional payment that is due. So on calculating the second one, remember, the second one, the rules say when you are calculating the basic amount, if it's over $1 million, if it's lower than 1 million, you take the lower of the basic amount or the estimated amount. If it's above $1 million, you take the estimated amount. So which means that on calculating the second provisional payment, I just need to do this. This applies when you are calculating the second one, the first one. So when you are, the rules for the second one, if the taxable income, taxable exceeds 1 million, then you have to choose the estimated amount that has been calculated. So in this case, our taxable income is going to be 4,125,374 multiplied by 28%. Then from here, you have to say less first payment. Less first payment. Remember, the first payment was provided the above as 520,761, and this is the second provisional payment. Is therefore going to be equal to any questions? Any questions?
I think on my side, I need first to practice this, then I can come back to ask the question because I know I am a bit struggling with these terms. Please. Then when I know, then I will have maybe the question much more better. Thank you.
All right, thank you very much. That actually takes us to the end of today's class. And thank you very much to the lecturer who participated and provided the answers to you. So everyone, this is where we end. The next time that we are meeting next week, we'll be dealing with gross income. So I honestly want to wish you all well for the next class and as you are practicing. So we'll try to recap what we did today for anyone who will have questions. I will also be available shortly for anyone who will just want to pop a question and may reply to those questions. But please don't forget to give us your feedback on the feedback form. And thank you very much. Enjoy the rest of your evening.
Thank you.
Thank you so much. Mr. Mpisi, the one more question I've got, the first and the second interim on micro business, it's always on the estimated amount?
Yes, you'll always be given an estimated amount. Even if you're not given an estimated amount, you'll always be given a taxable turnover.
Oh, okay. All right. Thanks.
Thank you.
How do you contact if we need help except our lectures from UNISA? Do we use this platform?
Please use this platform.
Okay.
Just try to type it for my attention.
Okay.
Then I will try when I'm going through the charts to pick up. And as well in the next class, if I've not responded to you, just immediately let me.
Oh, okay. Thank you so much. Have a nice evening. And Mrs. Vessel also and Miss Brown. Brown one.
Thank you very much.